Good morning, everybody. It is December 12th, 2023, 8:21 a.m. We are here 20 minutes earlier than we usually start because we've got CPI today. Ladies and gentlemen, CPI, Consumer Price Index. We are going to find out how bad inflation is in the United States of America or how good inflation has started to decline in the United States of America. I am here with my Duncan, as always. And today we will see if this is the last cup of Duncan I have with inflation coming in at 3.2%. Because you know what? We need inflation to come down. And the reason we need inflation to come down is because the stock market has had a pretty phenomenal month. S&P 500, I didn't even notice last night until around like 10 o'clock when I looked at the numbers. 462.20 on the S&P. We ended after hours. All big seven were down about 1 to 1.2% yesterday. Nvidia, Tesla, Amazon, Microsoft, Google, all of these guys were down. And the S&P somehow, because enough companies in those other 493 ended up doing somewhat well to get the S&P 500 up to its 52-week high. Right now in the pre-markets, we are at 462.96. We are up another 0.2% in the pre-markets, trying to touch 463. Inflation and CPI, which we will get in 8 minutes, can fundamentally change everything if we don't get an answer for inflation coming down. So right now, markets are excited. We got, markets looking really well. Palantir up 1.18% right now. We got Tesla up 0.21%, Coinbase up 1.8%, Robinhood up 1.54%. A lot of companies doing well. Big tech is still down. NPay is up 0.82%. Bitcoin is almost at 42,000, 41.76. Microsoft up 0.3%, but 0.23%. But the question is, will inflation come lower than expected? Because if it doesn't, it's going to be tough to see if we have the market continue to rally. Torbone, Michael, Victor, Adam, Tomas, Rock and Robbie, Sethy Roth, Kevin, Colorblind Collector, Broccoli Bob, Tessa Best, Sam Chen, Doug C, Garcia. Garcia says, I thought I was stuck with Meet Kevin. Garcia, thank you for being here. I like Meet Kevin as well. I enjoy his live streams, but I'm happy you are here. I appreciate it. It means the world. Jared, Noodler, Jeremy, Win, Deepin, David, how are you? Lussy Picker, Kite, good morning, everyone. Good morning to you. Felicia, I get paid to wait. Sasky Rose. All right, everybody. Let's get into the market open. So I think let's start off. We got CPI in 7 minutes. I think what's very important for us to do is to go through the CPI of last month and the expectations for this month. Brian Robinson, hello. Thank you for being here. And let's discuss basically what we've got going on right now when it comes to CPI. So first, let's look at expectations of today. This is what all the big banks are expecting. Most big banks are expecting 3.1, some of them coming in at 3.0, but pretty much all of them are in consensus at 3.1. Leza, good morning from Long Beach, California. Good morning to you. You're up early, 5:24 a.m. So seems like you care about the Consumer Price Index, which we all should care about the Consumer Price Index, but somehow we have been manipulated to care about Kim Kardashian more than the Consumer Price Index when the Consumer Price Index matters more than Kim Kardashian. It's just that simple. So all of us should obviously care about this and keep going. Mom's iPad looking right. Did you know this is my mom's iPad? Literally, this iPad in the background is I bought this for my mom in 2017. I had my first job. And I made it was on sale for $330, and I got it for her as a surprise randomly. And she was so happy that I got, but now she doesn't use it because people don't use iPads that much anymore. So I was like, all right, at least I'll use it for something. CPI expectations, as you can see here on the screen, the median target is 3.1. Bank of America, Scotiabank, TD, Citi, Citadel, Goldman Sachs, all of these guys at 3.1. Usually it comes in line with consensus. I mean, consensus has not been wrong. I think the market rallies if we see 3.0. If we get a 2 handle, we're going to the fucking moon. Okay, we're going. Sorry for the French. Hope everybody's awake right now. If we see a 2 handle, we see 2.9, we're going to the moon. We're probably not seeing 2.9. And I think although energy will come down more than expected and shelter will definitely come down, 2.9 is going to be a bit difficult to get. I think we're not at that stage. It's kind of like when you're losing weight. I've used this analogy many times, but when you went from, I'm a perfect example. I went from 180 to 143. And then I was trying to get from 143 to 139, and those extra 4 pounds, I just couldn't do it, right? Or even 150 to 143 was really challenging, but 170 to 150 was very easy over the past couple months. So when you get to this level of inflation, it's a bit harder to get this to come down. And I think, it will be a bit more difficult than what we think. But if we can get 3.1 or 3.1, I think the market's kind of flat, maybe tanks a little bit, not tanks, but goes down a little bit. 3.0, I think the market has fun with this. 2.9, we go to the moon. 3.3, if we tick up, it's not going to be good because the S&P's had a really good month and, the overall markets have had a really good month. We can't mess it up with inflation. That's just not going to be the best. Now, we got inflation in 4 minutes. Here's the October report, just to give you guys a little bit of context of what we're looking at. So in October, the index increased 3.2% month over month, year over year. And the energy index fell 2.5% in the month as a 5% decline in the gasoline index more than offset increases in other energy component indexes. If you look at oil prices all throughout the month of November, this is for November CPI, right now WTI is at $70, Brent crude is at 75. We were pretty much at 75 to 80 max, or maybe like 84 max in the month of November. So from that perspective, and I know some of you have, at least across the world, definitely in the United States, you've seen your oil prices come down every day. If that's the case, I think energy is going to continue to fall. Energy index fell 2.5% over the year. This was last month. I think, this 5% decline in gas, maybe it's a little bit less than 5% decline, but we're going to see energy come down. Food index increased 0.3% in October after rising 0.2% in September. So that was up a little bit. Index for food at home increased 0.3% over the month, while the index for food away from home rose 0.4% in the month. The index for all items less food and energy rose 0.2% in October after rising 0.3% in September. This is auto vehicles also came down. The used car index came down, which is really good. We thought there would be some supply side pressure because of the automotive strikes. That didn't really affect used car prices. In November, everyone went back to work. There's no more strikes anymore at Ford, GM, or Stellantis, which means that should help put less of a strain on used cars because there's going to be a lot more cars entering the system. And then shelter is going to be really interesting to see how shelter comes down in a significant way. So energy was the story of October CPI. November CPI, which is coming out in 2 minutes, is going to be either a story of shelter, potentially, from those lagging indicators finally catching up, or it is going to be a story of energy continuing to fall off a cliff, which, it has fallen off. And as what we saw over the past month in energy prices, oil prices, gas prices, we've seen it come down, and I would be shocked to see it not come down even more. This is the website, bls.gov/CPI, if you want to check it out. This right here, in 1 minute, I will refresh, and we will get a new PDF for CPI in November. And literally in 1 minute, the entire economy, the entire stock market is going to react to these numbers that are released, which is why this is so exciting. This is so interesting. Benny says, when is it released? It's released in 30 seconds. This is the reason to wake up in the morning and get excited. Okay. It's like, this is what Americans should be excited for. This is what people around the world should be excited for, because we get to learn about the macroeconomic indicators that influence the very infrastructure of how our economy operates at the end of the day. And so I'm excited. I don't know if you guys are excited, but I'm very excited because either my stocks go up today or they go down. And this one number is pretty much going to determine what happens. So it'll be interesting to see what happens. Kyle, thank you for being here. Kevin Moran, thank you for being here. Anthony says, no, Mitt, you're the reason. Anthony, I love you. Thank you for being here. All right, here we go. Numbers are out, folks. Here we go. It should be out in 1 second. Pressing the button. What do we got? Okay, it's not there yet. It's not there. It should be out in a second. I'm refreshing. You guys see me refreshing, right? Yeah, you guys see me refreshing. It's not there. It should be there in a second. This one lags a little bit more. Oh boy, this is like even crazier. This is crazier. The excitement. I can't handle this. I cannot handle this. Oh my goodness. This is why I need the Bloomberg terminal, because that thing comes out way quicker. Oh boy. Why isn't it loading? Oh my gosh. Is it crashing the servers? It's 8:30. Technically, it should be here in like a couple seconds. All right, here we go. What is it? Hold on. What do we got? 3.1. 3.1, baby. So we are down from 3.2. We are down from 3.2. Not too bad. I'm looking at the stock market right now before we get into the report. I just want to take a look at the stock market. 3.1, 3.1, S&P's up, baby. There we go. Okay, let me show you guys the market real quick, and then I'll get into the depths of the report, because obviously we got to get deep into this report. We got a lot to dive into. Thank you, 372 people, for being here. But let's see the quick reaction on the stock market. S&P is up 463.54. S&P is trying to make an attempt for 464, which is like absolutely incredible that it's trying to go for this right now. Here we go. Palantir 1807 up 1.69%. SoFi up 1.12%. S&P, there you go, folks. 0.32, 463. So the initial reaction, the consensus was 3.1. The initial reaction so far has not been sell it off, has not been it's still increasing, has not been this is too much. It's been, you know what? 3.1 is okay. 3.1 is okay. The market is not necessarily upset at that yet. ARK Innovation up 1%. Disney up 0.7%. Tesla up 0.56%. Robinhood, let's get to that bad boy. Robinhood up 1.45%, 1188. CleanSpark up 4% in the pre-markets. And let's check on Bitcoin real quick, then we'll get right into the report. Bitcoin 41,956 up as well. All right, so not bad. Palantir up 1.52% at 1804. Let's get into the report right now. For those that are just joining, 3.1 came out, and this is the number we're looking at. We got Chris in the chat says, this is not good. Core CPI inflation was unchanged at 4%, in line with expectations of 4%. I agree. Core CPI not coming down is definitely not good, but it's also not above expectations, which is why I think the market is at least giving a little bit of love to the report. My fear was that if we come in within expectations or slightly below, which 3.1 is, it's slightly below 3.2, that it would get really bad. The market would think that's not enough, but apparently, the market thinks that this is at least enough for now to be okay. All right, let's read for this. The index for shelter continued to rise in November, offsetting a decline in the gasoline index. So shelter is still going up as per the Fed's indicators. Now, we know shelter has a bit of a lagging indicator for the Fed. Mortgage rates have come down from about 8% to from 7.1 to 6%. But for now, the Fed thinks that shelter is continuing to rise. The energy index fell 2.3% month over month, as a 6% decline in the gasoline index more than offsets increases in other energy component indexes. This was 5% last time. It was a 5% decline in October, and it was a 2.5% decline month over month in energy. Now it's 2.3% month over month in energy, and a 6% decline in the gasoline index. So gas is continuing to fall, oil is continuing to fall, which is why that's coming in a little bit lower. The food index increased 0.2% in the month of November after rising 0.3% in the month of October. The index for food at home increased 0.1% over the month. In the index for food away from home rose 0.4%. So food continuing to increase, basically the same. It increased. Oh, no, it's actually better. So food increased 0.3% in October. It increased 0.2% in November. Right. So that's a little bit lower. That's not horrible. We're probably not seeing it in our food prices because food is, honestly, guys, food is expensive. I went to a Subway yesterday. I was thinking of getting a foot long. It was like $14. I was like, fuck this. I'm not paying $14 for a foot. This is just ridiculous. So the food is getting up there, and it's still higher. The all items index rose 3.1% for the 12 months ending November, a smaller increase than the 3.2% in October. All items less food and energy index rose 4% over the last month, as it did for the past 12 months ending October. So technically, this is not the best report given core CPI has not come down. Markets are starting to sell off a little bit. So we saw the S&P try to hit 463.50. Now it's at 462. Still green. We could easily see red in the pre-market. We could definitely see a bit of a sell-off here in the pre-markets. That euphoria is now coming down. So Palantir was up 1.5%. Now it's up 0.84%. Robinhood was up 1.8%. Now it's up 0.94%. So TFC is doing great in the pre-market, 34.75. TFC is up 0.93%. But in general, market's cooling off a little bit from the first couple of minutes, or I guess seconds, of the CPI report. Ray says, good morning. I'm late. Ray, we got 3.1. 3.1. That's what we got on CPI. 3.1 on CPI. Meats, poultry, fish, and eggs decreased 0.2% in November. That's not bad. that a little bit of a decrease in some of the food that we're seeing. Energy index obviously fell 2.3%. The index for fuel oil fell in November, decreasing 2.7%. The natural gas index rose 2.8% of the month, rising 1.2% over the previous month. We've seen this while oil prices come down dramatically. Energy index fell 5.4% over the past 12 months. Gasoline index decreased 8.9%. The natural gas index declined 10.4%. All items less food and energy, which are two of the biggest components, rose 0.3% in the month of November after rising 0.2%. That's why I think we ended up being at 3.1. So the index for everything besides food and energy, which is a lot of stuff, but food and energy are some of the core things that, can give a significant decline, is up 0.3 versus 0.2% in October. That's why, if that was at 0.2, we might have seen 3.0 on inflation top line, but we did not see that. Shelter index increased 0.4%. This one is interesting because we know the Fed has a lot of lagging indicators when it comes to shelter. Some of those lagging indicators can be about 6 months before they end up showing up. So, maybe not until January, February, we really see shelter decline the way we're starting to see it decline. We're seeing mortgage applications go up because mortgage rates are coming down. We're seeing housing prices start to go down. We're seeing apartment rents start to go down. Obviously, New York City is still insane with some of the rents, but in general, overall, in the United States, it's coming down. So we're seeing housing come down. We're seeing apartment rents come down, and we're seeing mortgage applications go up because mortgage rates are coming down. That should lead to a broader decrease in the shelter index, but that's not what we're seeing in the Fed's indicators, which, is a reason why some people are bullish that the Fed will cut interest rates eventually. The shelter index was the largest factor in the monthly increase. Wow, look at this. The shelter index was the largest factor in the monthly index outside of food and energy. And a lot of people think that the Fed is getting that wrong. The used cars and trucks index rose 1.6 in November, ending a string of 5 consecutive monthly decreases. Wow. Why did used cars go up? Why did used cars go up? Used cars were coming down 5 consecutive months in a row. Why are they up now? Among the other indexes that rose in November was the index for motor vehicle insurance, which increased 1% after rising 1.9% in the preceding month. So vehicle insurance increased lower than what it rose last month. But why are used cars going up? That's not good. That wasn't supposed to happen. Medical care index rose 0.6% in November after rising 0.3%. Yeah, that's another reason why CPI only came. It's honestly a blessing we got 3.1. We got used cars going up. We got medical care going up. We got shelter going up. We're getting a lot of things going up. Clothing came down. Index for apparel fell 1.3%, so that's not too bad. It fell 1.3% and it was up 0.1% the previous month. So you got some things actually dramatically coming down, and you've got other things like shelter, used cars, and medical care going up. Interesting. This is really, really... Rick says because the Cybertruck is ugly. Oh my gosh. That's hilarious. That's so funny. That's interesting, man. Used car index came up. I'm trying to rationalize. Put it in the chat. What do you think is the reason? Why do you think the used car index went up? That is so... You would think that it was coming down. It came down for 5 months in a row because used cars were at ridiculous prices. It is starting to come down. But I guess not as per this one. Used cars, healthcare are cyclical. That is correct. That is true. No cars on the lot. That might be a reason. A lot of people buying new cars. Auto strike. Well, no, the auto strike was for the past 2 months. The auto strike got resolved in November. I was thinking that because the auto strike got resolved and you have okay, that's actually a good point, JTel. The reason used car index probably went up is because the auto strikes were in September and October. But the effects of the auto strikes, which is less supply of new vehicles, probably didn't take an effect until November. This is why I wear the fedora sometimes. I feel like Sherlock Holmes in this. If the effect of the lack of supply didn't happen until November, obviously consumers would pick used cars over real cars or new cars because there's not that many new cars, which means the prices of new cars go up. Lack of supply, more demand, new cars go up, which means they go to the used car market, which means a lot more demand goes into the used cars index, which means that ends up raising prices. So that could be a reason that those strikes ended up showing up a couple of months later. Let's go to the 10-year as well. What is the 10-year doing right now? Where is the 10-year? What is it doing? 10 years down. 10 years down. It's up from 4.1 yesterday, but 10 years down. 4.281, 4.218, 4.216. It's coming up a little bit more. Oh, there it was right there. So yesterday it was at 4.1. Well, it was at 4. Let me zoom in on this a little bit more. Yesterday was what? December 11th. We were at 4.239. We're actually down 4.216. We're down just a little bit. We're down. It spiked up this morning. Look at the 1 day. Oh, let me check this. Look at the 1 day. Yeah, I see your point. I see. Well, yeah, it came right. Yeah. If you look at the hourly, yeah, look at that. 10-year is spiking up. So at 8:32 is at 4.17. Boom. There you go. 4.218. Okay, where's the markets? And markets I've still not sold off yet. S&P is still okay. Google's a cheater, so Google's a mess right now. Bitcoin is at 41,960. Palantir's up 0.84%. Microsoft 371. Not too bad right now. Where Tesla's at 239. So markets have not fully sold off. S&P is still green right now, but the 10-year has spiked as a result of this stuff coming down. Let's get an update on interest rates. The question now, for those that are just tuning in, CPI came in at 3.1%. The question now is, do we get those rate cuts in March? And it seems a little unlikely, but let's get an update on why the Fed has to cut next year, but if it's going to happen in March or not.
Talk markets. Barry Knapp is here. Iron Secret.
For me, the key issue that you were getting at with Steve, and for Steve even to ask about, is in September, the Fed had been on this, call it immaculate disinflation path for most of the year. The idea was inflation was coming down. That allowed them to stop the hiking process and even, talk about reversing it later on. But in September, they put out a forecast that said that they weren't going to reduce the policy rate to below 5% for something like 15 months. And he added a variable in as much as he decided, or the committee decided, that they needed weaker growth and higher unemployment in order to actually start reversing some of the rate hikes. And so that's the key issue, because Waller intimated that that wasn't the case, that if inflation came down, even if the unemployment rate stayed below their estimate of the long-term equilibrium rate of 4%, they could still cut. But that's a real change in the way, the framework that Steve was talking about that he put in place in September. So at that point, I'd been expecting the market to rally, finish the rally retracement of 2022 and finish the year at 4,800. But when they added that framework in September, to me, that was a big negative change. And then I changed my forecast and said, oh no, I think we're going to probably to 4,200 first. Of course, we went to 4,100.
Right.
Then the Fed partially pivoted again. I called it a policy put. When long-term rates moved up, they said, okay, well, as you intimate, or said, the market's starting to do the work for us. Well, here we are. All right, we're going to get the forecasts. Are they going to change the framework from slower growth, high employment, and lower inflation to just lower inflation?
By the way, the Fed's dot plot has already been submitted. So the CPI, PPI numbers do not affect their little playground coloring book dot plot, in which they expect rates to either go up or down over the next couple of years. That's been submitted. So this number is going to have no effect on how they, assess their framework over the next couple of years.
Right. Which is a pivot back the other way. And now that's, you ask about credibility. I mean, how do you even?
But if you even entertain the idea that you're going to lower rates, isn't that going to work against him?
100% it will. 100% it will. Yes, because what I was saying with respect to the bond market was that any rally was suspect if it wasn't led by 2-year notes. Mm-hmm. And the idea of the only way 2-year notes can really rally significantly is if the Fed's ready to cut. So, sure, but that.
Although they've done it on their own. They've assumed that the Fed was.
That's right. But ultimately, I was in the camp that they're going to cut at least 4 times next year. I thought they were going to start in March until we got Friday's unemployment rate decline to 3.7 from 3.9. Now I think it starts in May. But the reason I'm so convinced that they have to cut next year is because of the inversion of the yield curve. Now, this has created a real problem for small banks, a real problem for small business,
may break.
and to finance the federal government, right, quite frankly, because what Treasury Secretary Yellen did by issuing a ton of bills. Okay, that's getting funded out of government money funds. But the rest of the issuance is in the so-called belly of the Treasury curve, 2-year notes to 7-year notes. That's the banking system buys those securities. And the banking system, small banks right now are shedding government securities at a 20% annualized rate.
But how much do you think Jay Powell is actually thinking about the issues as it relates to, not to the banks? I think he thinks a lot about. I don't know how much he thinks about the government debt.
Yeah, it's a fascinating question, because when you go back to the last similar period to this in the 1960s, Bill Martin, who was the Fed chair, famous quote I've used all the time, which is the Fed is independent within, not of the government. And they were very conscious of what it meant for financing the debt and deficits at that time, which were growing rapidly through the whole guns and butter and Great Society stuff.
I think Jay Powell is very cognizant of the fact that we are going to be spending more on interest payments than we're spending on the defense budget because of where interest rates are at right now. I think he's very cognizant of it. I think there's not a day he doesn't think about the fact that we are spending $2 billion per day in the United States of America financing the insane level of debt we have for our interest rates. So it's like it's absolutely on his mind. For those that are just joining, 3.1 inflation was the headline number. S&P 500 now barely up in the pre-market, 0.01%, 462.04. And well, you know, this report wasn't the best because 4% was the core, and that was expected, so it didn't really come down. We had used cars go up, we had apparel come down, we had medical care go up, we had energy come down, shelter went up, kind of a mixed bag, hodgepodge of a lot of stuff. So the only thing you got was really 3.1. So it was really a blessing that we came in lower than what was expected. But I think Jay Powell, as the guys just said in the clip, he is very cognizant of the fact that the Fed has a lot of debt. The thing is, March, I don't think those March cuts are coming. I mean, like, let me make a poll right now in the chat. Let's see what you guys think. I do not think we are getting March cuts the more I think about it. I mean, I understand the argument for March cuts, and the economy obviously slowing down, so that there would be, you know, a reason for why we would get March cuts. But the economy would have to slow down dramatically for Jay Powell to go against his motto of 2%, which I don't think we're going to get to 2% by March. I just don't think that's going to happen right now. Chris says January might be a very tough month. Take your profits now and sit in cash. Either Chris is going to be right or Chris is going to be wrong. But January could be a tough month given some of the stuff we're seeing. Now, another reason why January might be a tough month is because unemployment, although we got that 3.7% report, I don't think anyone believes unemployment's at 3.7%. A lot of those were seasonal workers. A lot of those were people who had multiple jobs. A lot of those are workers that were coming back from being off strike. Bankruptcies in the United States are going up. Small businesses are, you know, going bankrupt more. There's actually an index that tracks that. We talked about that the other day. And unemployment, for all intended purposes, is going up. 2 companies, I got alerted by the Wall Street Journal, started doing layoffs. Hasbro and I think Citibank, if I'm not wrong, cut like 1,000 jobs. And that comes after Spotify cut 17% of their workforce. And then a couple of the companies I can't remember off the top of my head, but I know you guys have been seeing the layoff news that is starting to happen over the past couple of weeks. And because of that, I think we're seeing a little bit more of a hesitation. Right now, we got 71 votes. 17% of you said March cuts are happening. 82% of you said it's not happening. Yeah, I mean, if I had to guess, I would say we're not getting a March cut. We would have to see inflation come down so dramatically to get that March cut. And I just don't think the Fed needs to be able to do it. Because if the Fed doesn't need to be able to do it, then why, would they go into it? Let's look at a survey of when people think the Fed cuts will happen. Most are saying by mid. Oh, Ernst & Young. Yes, that was another one. Ernst & Young. That is the other one. They cut, I got that report last night. They cut jobs as well. And they're a consulting firm, and obviously they felt like they didn't need enough people. Let's see a little bit here around why CNBC survey finds that mid 2024 will get interest rate cuts.
Today, the Fed kicking off a 2-day meeting to plot the future of interest rates. Can investors expect a cut in the near future? That is the conventional wisdom. Let's see how conventional or unconventional Steve Leisman is thinking about all this. He joins us with CNBC's Fed survey this morning. Steve.
Hey, good morning, Andrew. Yeah, the Fed survey for December finding that cuts are indeed in the cards. maybe not as aggressively as the futures market has priced in, but they're decidedly in the forecast of our survey respondents. 100% say the Fed leaves rates unchanged this week. 53%, that's the first cut in June 2024. That's the first place where more than half see a rate cut. It moves up to 69% for July, and 4.53% is the year-end funds rate. November 2024 is when the Fed, on average, ends QT, but our 35 respondents are all over the place on that particular forecast. Here's how they game out those next several years. 529 ending the year. That's because some people, at least one person sees a cut there, but ultimately unchanged by the end of the year. This year, that is. 2024, 453. So 85 basis points of cuts, not the 120 built in the futures market. And then December 2025 goes down even more, 373. Peter Bookvar, Chief Investment Officer at Bleakley Financial Group, writes into the survey, I still believe Powell has the memories of the 1970s in his mind and will be more stubborn in keeping monetary policy tight for longer than markets want him to be. It may seem far off, but next year could be the year when the Fed ends quantitative tightening, where it's reducing its balance sheet by $95 billion. We ask people when it will happen and by how much. This $7.7 trillion balance sheet goes down to 6.2 by the time the Fed stops, and bank reserves decline by 2.6 trillion from 3.4 trillion. So 8 or 9 or 10 months, depends on how you count it, of additional quantitative tightening built in. Inflation seen coming down to 2.7 next year. About a third of respondents forecast the Fed will hit the 2% inflation target next year. 37% say it will happen in 2025.
So that's really interesting. A third of respondents think that it's going to happen in next year. Or sorry, I think it was half of the respondents think it's going to happen next year. A third thinks it's happening in 2025. If we get inflation down to 3% or to 2% by 2024, obviously there's going to have to be some level of rate cuts. I mean, there's going to be at least one cut. Now, the real question here, thank you everybody for being here. We got about 35 minutes until market open. We're going to discuss a lot of things. We have new Palantir partnership to discuss. Google losing a major lawsuit, just more bad news for Google. We got a bunch of headlines. But the interesting here to discuss is, do we need the Fed to lower interest rates in order to have a bull market in 2024? The argument for why we need that to happen is because, stocks cannot have the cost of capital being this high in order for them to have liquidity to be able to go higher. On top of that, money markets, if they're getting 5% in the stock market, $6-7 trillion that are on the sidelines, why would they come into the stock market if they're getting it in the bond market or in the treasury market in order to, give more money and liquidity to equities? Like, there's just no reason if you're getting that same return with zero risk, even if the stock market's going up a little higher. That's why we need those rates to come down, because then that money starts coming in. A lot of stocks start going up. That's the case for why interest rates need to come down in order for the market to go up. Interest rates, however, don't need to come down in order for AI to be AI, right? So, if Microsoft doesn't care about interest rates, Google doesn't give a shit about interest rates. They care about it from a macro perspective. Obviously, Google has advertisers. If interest rates are high, advertisers might not want to advertise, right? So that affects their business. But Google doesn't have debt. Microsoft doesn't have debt. Tesla doesn't have debt. They don't need to worry about interest rates. Interest rates affect their businesses from a consumer perspective, but it's not literally destroying their ability to raise capital because they have so much capital. They have so much cash. So the question then becomes, can they operationalize AI and create products and services that are not just marginally better, but significantly better, to the point where an extra $30 a month for Microsoft Copilot, every enterprise in the entire world is like, yes, we will pay that. Is that possible? If that is possible, which is what analysts like Dan Ives think, it's what analysts like Cathie Wood think. Obviously, Tom Lee is in that camp of he's more macro, but he thinks that AI is still important. Dan Ives being one of the most vocal, now saying Apple will get to a $4 trillion market cap by the end of the year next year. All of these analysts are basically saying that AI is going to enable a level of growth that we haven't seen before, and that growth is going to supersede any macroeconomic indicators. It's why, I've asked Dan Ives on my channel, what do you think about valuations? And he honestly doesn't give a shit about valuations because he's analyzing this from a tech perspective. And, I know a lot of people say whatever they want to say about Dan Ives, but the guy is traveling. He has 2.5 million miles he's racked up this year. He told me from airplanes. The reason he's traveling is because he's actually talking to these people. He's actually looking at these use cases for AI. And when you're on the field talking to people, you start to recognize that there might be more to the story than meets the eye right now. So if AI is good enough to sort of enable growth, and then the question becomes, for how many companies is that going to enable growth? Maybe the markets can continue to go higher. If not, then it's going to be a little bit tougher to see the markets rally. Let's get a check on some of these equities before we move on to some of the news stories that I want to share with you all. Palantir 1779, barely up now in the pre-market. We've got it went down significantly from when the CPI report just came out. Nvidia's down, Tesla's down, Nvidia 461, Meta's down, Microsoft's down, SoFi's down, MicroStrategy's down, CleanSpark is up, Robinhood some maintaining a little bit of green, 0.09%. Yeah, see, this is why CPI is so important. You had a company like Robinhood touching $11.90 last night. Things were peachy. That CPI report comes out, market doesn't like it, gets sold off. And CPI affects everything at the end of the day. PayPal is up a little bit right now. Spotify up a little bit. Affirm up a little bit. Elf up a little bit. And so, again, some of these small caps are up because they have nowhere else to go. But you got some of the other bigger companies like Tesla, Nvidia, Meta. They're not going to keep running on a bad CPI on a day, on a year when they've already ran so much, right? Coinbase is up, Marathon is up, Riot is up, Bitfarms is up. So some of these Bitcoin companies are up. Obviously, Bitcoin has recovered a significant amount. They went from 44,000 down to almost 39,000. It was touching that 40,000 range, spiked back up to 41,808. So the crypto markets have recovered a little bit since Sunday night when we saw that flash crash. $330 million were liquidated, starting to go up a little bit more. So crypto seems okay. S&P right now at 461.89. Even if we end at 462 for the day, I think we will be, even if we end the year at 462, I think we would be very, very excited because right now we're at a 52-week high for the S&P. So just maintaining that would be awesome. But it's going to be interesting to see at 9:30 when the market opens. How does this end up playing out? Gilf Magic says, I am waiting for a Tesla sell-off. I can feel it coming. Honestly, I have no idea what's going to happen in Tesla. I do know it's been one of the most boring stocks over the past couple of months because there haven't been any catalysts. Cybertruck was a dud in terms of a catalyst for the stock. I've said that I've started a Tesla position, so if it does sell off, I wouldn't mind at all adding at 200 or below 200. That would be honestly a great time for me to really substantially add. I do have the dry powder available. A lot of it is reserved for Palantir if we get to 15 or below, but I'll nibble at Tesla if we get to that low 200s, but I don't know if we're getting to low 200s. I mean, I think that would be a significant decline. And I don't know what would be the catalyst to get us to the downside to see happening. Chris says he's trimming some risk. Chris, give us some names, buddy. What are you trimming? What are you trimming? Let me give a shout out to Chris's Patreon. It's on the Finance Junkies description. If you just type in Chris Patel Patreon, you'll find it on Google. He's the only guy in the world that has Chris Patel Patreon. So $5-10 a month, you can subscribe to his Patreon. Gives a lot of good due diligence on his Patreon. But Chris, give us some juice. What are you trimming? What are you getting rid of that's risky that you don't want to be in for the next month? December says you're going back to 3.3 to 3.4. Interesting. Well, I mean, if gas ends up being the way it is, at least for energy, we don't have to worry about. But for some of those other indicators, example, used cars, if that thing is lagging another month like it was from the auto worker strike, yeah, maybe December could go up a little bit more. But I guess we'll have to see how November ends up turning out. Nick says, I've trimmed Amazon. Let me know in the chat what you guys have trimmed or what you guys are wanting to buy. If you've done any trimming at all, if you're actively managing your portfolio to any extent. And let me see what happens. Let me go to that poll. What did I do? I did on the poll. I said March rate cuts. 178 of you, 184 voted. 74% of you say no rate cuts by March. 26% say yes. Well, I mean, this is going to be interesting. Now the S&P is negative in the pre-markets, 461.70. Tesla's negative. Russell is flat, ironically. This is the one that the call options have gone pretty massive for Russell. It's going to be interesting, honestly, if the market just digests this report and doesn't care that much about it. I mean, look, the report's not amazing, but the report's also not horrible. It's not good, but it's not horrible. So it'll be interesting if the market kind of just overlooks it and moves on and doesn't take it that seriously. Or if the market, ends up thinking that this is actually a really, really bad report and that we've got some issues going on in the broader market. Broccoli says trim some options and going straight to shares now. Trimmed 50 out of 700 shares of Amazon. Buying Bitfarms hard. It's my only priority right now. I have CleanSpark up and sold a lot. Some buying more. The only thing I would say about Bitfarms, and the only reason I can comment on this is because I made some money off the stock in the past couple of weeks. It's up like 100% in the past week and a half. So just be careful with Bitfarms. I mean, it's up a lot. I know it's correlated with Bitcoin. I get it, but dude, it's up a lot. Like it was at $1.07 a week ago. It's at 2.30. You know, like the reason I trimmed and I could have, made a couple thousand instead of made $600 on the options is because I just felt like it went up way too quickly, like way too. Now I know crypto is crypto, so just be careful when you're buying it. It's up almost 200% in a couple months. Those things could come down if Bitcoin has another flash crash the way it had before, if it just stays flat. So you just got to be a little bit careful on that one. Okay, let's move on to Palantir. Let's get some good news into the world. We got a new update by Palantir, new press release by Palantir. Ladies and gentlemen, AIP and LLMs are entering a new industry. Okay? New industry. And that industry is waste management. Plascred Circular Innovations, Inc. enhances logistics and operations with Palantir's technology software in strategic collaboration. So I want to read a little bit from this and then we'll talk about this. Palantir's AIP platform is a cutting-edge platform that integrates and analyzes complex data streams, enabling organizations to take actionable insights and make informed decisions. Its advanced machine learning and AI capabilities, ability to orchestrate numerous models and LLMs for various tasks, and highly scalable architecture make it an ideal solution for tackling the complexities of modern supply chains and operational challenges in industries like upcycling. This is a company that essentially focuses on how we can manage our waste in a more meaningful way. The partnership signifies a major step in integrating advanced AI technology into their environmental efforts, particularly focusing on refining supply chain logistics for plastic waste feedstock and optimizing operational processes. This is a Canadian company as well. So this is a German company. This is not a Canadian company. They're going to be working in Canada, but this is a German company. The collaboration will commence with the implementation of Palantir's Foundry and AIP at Plascred's patent-pending Primus plant as a beta test. This initiative is aimed at harnessing the power of Palantir's technology to optimize operational efficiency, resource management, and decision-making processes. I mean, it's pretty much the same stuff we've seen in a lot of these Palantir partnerships with helping other companies optimize resource management, supply chains, efficiencies, decision-making, etc. But it's really interesting that it's happening with a company that focuses on waste management. The Maximus facility is designed to produce approximately 2,000 up to 10,000 barrels a day of zero sulfur green condensate and remove approximately 300 to up to 1,300 metric tons of plastic waste from the environment while using minimal energy. CEO of Plascred says after this beta phase at the patent pending Plascred Primus, we plan to extend this technology to Plascred Maximus. The insights gained from Primus will be crucial in shaping the design and functionality of Maximus, underlying our commitment to sustainable industry practices. Hannah Tamori, Palantir's Canada commercial business lead, says we're excited to work with Plascred and seeing our software being used by a company at the forefront of the environmental sector. This collaboration is a testament to our commitment to working with mission-driven companies of all sizes across Canada, helping them unlock the potential of their data. Really, the reason why I thought this was interesting is because waste management, obviously a very big company, a very big industry. Everyone has trash. It also is similar to Palantir's partnership with Rubicon Technologies. Rubicon is another digital AI-enabled waste management company. I think their stock is, I don't know if their stock's been delisted or not, but their stock has been pretty Rubicon. Yeah, they're still on the $1.73. They're right now on their stock. They were a very interesting company because they're using a unique form of ways to like track your waste and like see if you have collectible items in your waste or like valuable items in your waste. And then they're able to like take it because once you give up your waste, it's like technically not your property. And so Palantir is working with them and trying to make some software in that respect. But waste management is a big issue. And the reason I think this partnership is so interesting, it looks like a very surface level partnership. When you go deeper into it, energy is ultimately what is underlying the foundation of this partnership. Removing plastic from the atmosphere, being able to operationalize how we can get rid of carbon dioxide and metric tons of carbon dioxide from the atmosphere. And ultimately that means making sure the raw goods and raw materials of our supply chains are also in check. The Palantir partnership with Trafigura, which came out in May of 2022, also a vastly underlooked partnership. These little companies they're working with are doing a lot of R&D, and I'm assuming they're either getting paid for it or they're basically having zero costs with enabling these partnerships to be able to conduct a better research and development on when they try to tackle very large scale energy climate change issues. I think Palantir is going to be in a prime position to be able to do this because of all the research that they've done over the past couple of years working with these smaller companies and these smaller partnerships. Jittery Hobo says Palantir will help all industries. It doesn't matter if you're cleaning up crap or fixing people in hospitals. I agree. There is a lot that Palantir is trying to do here, which is exciting. And, you know, that's why I also think that this partnership is really interesting. I'll be talking about it on the newsletter today as well and Daily Palantir episode, dailypalantir.com/subscribe. If you want to subscribe to the newsletter, it is free, dailypalantir.substack.com. free newsletter every single day. You get it 5 minutes towards the end of the day. And I'll be analyzing this partnership as well. The other reason I think this partnership is also really interesting is because we haven't seen an international commercial partnership for a while. And this is in Germany and Canada. They're operating in Germany and Canada. So at least this counts as another international commercial client that we're seeing. And hopefully we just get more of those international commercial clients as well. But I wonder if they will work on their logistics as well. Yeah, well, the partnership talks about their supply chain and optimizing supply chain and refining supply chain logistics. That's what it's saying. But it's also interesting because a couple of last week we saw Palantir partner with the Horse Integration Safety Authority, HISA. I didn't know this thing was a thing, but HISA is an organization that protects horses and makes sure that they are safe before they go out to horse racing. So before we have horses race, HISA makes sure that the horses are like safe and like, you know, like they're protected and all that stuff. And like they're not treated in a bad way. AIP and LLMs are now being enabled to help horses and to help remove plastic from the atmosphere, which is very interesting, right? Just the variety of use cases we're seeing on AIP, I think is pretty substantial. So that was the new update on Palantir. Palantir right now, what do we got in the pre-market? We got 0.45%, 1785 in the pre-markets. Let's move on to Google. Let me get this clip ready for you guys. Google apparently has lost a case with the FTC in regards to Epic Games, which was a lawsuit that Epic Games sued Apple and Google. Apple ended up winning. Google ended up losing. And why is Google losing? I don't know, but Google is losing. This comes after another day of bad news for Google when they faked their Gemini presentation, which was just not good to see them fake the Gemini presentation. They admitted they faked the Gemini presentation. So not been really good news over the past couple of days with Google losing this lawsuit.
And then we'll chat it out here. But look, the verdict comes from a committee behind Fortnite, and it caps a 3-year legal battle between those two companies. Epic Games in 2020 sued both Apple and Google, claiming they held monopoly power over their app stores, which let them squeeze app companies for up to 30% of their sales. Epic CEO Tim Sweeney cheering the decision, calling it victory over Google on X last night. It's the company's first major legal win in its years-long fight against Apple and Google. Now, after this weeks-long trial featuring execs like Alphabet CEO Sundar Pichai and Epic Sweeney, it only took the jury a few hours to come back with a unanimous verdict against Google. Now the judge in the case will decide what the punishment for Google will be. At risk, that slice Google takes from money spent within apps distributed through the Google Play Store. The judge will make that decision after the new year. But it's going to be a long time before Google feels any pain, if it even happens at all. A Google exec telling us in a statement it will appeal the decision, a process that could take years and could even go all the way to the Supreme Court. And guys, speaking of the Supreme Court, we're expecting to hear next month whether or not it will take up the case Epic mostly lost against Apple. That was back in 2021. No matter how these cases shake out, though, it's going to have big implications for those lucrative app ecosystems at Apple and Google, guys.
Okay, so let's just break this down.
Yeah.
What do you, besides having a jury,
That's a big difference, by the way,
which is
between
the
these two
biggest.
cases. It's the same fundamental thing.
Right. So was there anything distinctively different about this case?
A little bit. So you mentioned this earlier. Android's open in the sense that it does allow other app stores, unlike the iPhone. It does allow you to go straight to the internet and download apps to your phone. So there is some of that. But what also has been happening is Google, claims they're open and all this stuff. They found different ways to kind of close it down, like cutting deals with phone manufacturers to make sure that Play Store is the default, to make sure Google services like Maps and Gmail and so forth are the default apps. So there is a financial incentive for, let's say, your Samsung making a Google phone. They do have their own app store. They would love to continue that, but it's more lucrative for them to play along with Google and use those services instead. So that's part of it too.
What are the chances, though, that this decision obviously will get appealed, but to the extent that it will have a crossover impact on Apple or other companies?
Yeah, and this is a separate case. Well, these are two separate cases over a similar thing. So it's kind of unclear. Like, let's say the Supreme other app stores on their phone, and it's going to be interesting to see.
Just when you're in Europe, or
that's what it sounds like they're doing.
Okay, these guys are saying a lot of nothing. Google didn't pay the right lawyers. That's what happened. I mean, honestly, I'm trying to listen to their analysis. I don't know what it is with this guy. He's not that interesting to listen to, even though I watch some of his videos sometimes on CNBC, but he's just saying a whole lot of bullshit. Google didn't pay the right lawyers. How does Apple get away with this, but Google doesn't? Okay, we're going to finish this video, but Apple is much bigger than Google in terms of its influence on the App Store, right? Like, I know Google has more devices in general with Google Play, but if anything, that should give a little bit more credence for why Apple should be able to not be able to get away with this. But Apple is big, and they got the right lawyers to not get in trouble. Why did Google get in trouble? I don't understand why Google is getting in trouble right now. And if anything, Android is way more open than iOS. iOS is such a closed system. Android is way more open. Android allows way more flexibility. I mean, you know, Blake says, read the Wall Street Journal article. I have a Wall Street Journal subscription. I will give better analysis. Google paid the wrong lawyers. That's what happened. And that's pretty upset for Google.
They might have like a separate version of iOS. We don't know for sure. We're going to see how they get around this, but a separate version of iOS that allows this stuff. Microsoft is giddy over this, by the way. They want to open an Xbox store on iOS. Their executives have been talking about this. Epic last night, Tim Sweeney saying on X also that they're excited for that as well, to put their apps in different app stores.
Do different iOSs exist for different continents at this point? Like this would be a brand new, how do you figure this out? And where are you sleeping when the download comes through?
Exactly. It would be a huge technical challenge, but you've got to understand if Apple does go that route, instead of making it a universal global change, you can understand why. The App Store, the margins are so good that it's so profitable for them, especially on gaming, like on Fortnite, that it's probably behooves them to carve out Europe separately from the rest of the world and fight this country by country.
Well, the other thing is this is going to be
cross-border.
Exactly right.
But now we will have the in the wild real tests of whether what Apple's been saying all along,
security, privacy,
is real, right? And so we're going to find out. It'll be a natural experiment. We'll see if the phones in the U.S. don't have all the same problems that the phones in Europe have. If the phones in Europe don't have problems, then Apple will have lost that argument. If they do have problems, then people are going to say, you know what, I'm so happy that they were doing it this way the whole time.
And Apple's whole stance is, these payment systems that we use within apps, this is secure, this protects you, helps you manage your subscriptions better. Basically saying, going on the internet is dangerous to put your credit card in there. We do that all the time. By the way, they don't say that about when you use the Amazon app to buy toilet paper. They only say it when you buy Robux or something within the app. That's where you could be skeptical of that and naturally skeptical of that.
Steve Kovac, breaking it down.
Yeah, I mean, look, at the end of the day, I think that Google got the wrong lawyers, bro. I think they got the wrong lawyers. That's all I'm going to say. I think they got the wrong lawyers. John says, I still remember something Tanner said a while back that's been ringing in my brain for months. Google only has market share to lose. I think the analysis that Google has a search monopoly that they have to lose and that every other company has something to take from them is the correct analysis. The problem is, Tanner said that when Google was at $90, right? I remember debating with Tanner about this. So Google has done phenomenally well since Tanner made this call. The question is if he's going to be right long term, that because Google has everything to lose when it comes to search and nothing to gain because they already have a monopoly, is the decline in that business, which was up 11% year over year last quarter, $41 billion in ads, just those little searchable click ads. Does that decline significantly enough for the market to get scared? And then for the market ultimately to get to the point where, they think Google is losing enough market credibility. And then that 23 PE ends up being very expensive versus cheap right now, which I'm saying it's very cheap. Everyone's Googling the downfall of Google right now. Yeah, at the end of the day, I don't think the market's going to get to that point. I think the market's going to be a lot more excited because Google is going to continue to maintain its monopoly and it's not going to leave for a while. I think for that to really, look, Chris put out a really good tweet yesterday on this. I just want to share this as well while we're on the topic of Google. The traffic to Google search has not declined at all since CPI, since ChatGPT came out. By the way, for those that are just tuning in, CPI came in at 3.1%. So headline CPI, not too bad, not too good, but it did come down a little bit month over month. Google search market share was 92.21% to 91.54%. That was a 0.67% decline. Bing search market share went from 3.42% to 3.2%. So Bing went down as much as a little bit less than Google went down 1 year after the launch of ChatGPT. So if anything, you could argue that ChatGPT has taken away market share from Bing because less people are searching on Bing. But in terms of Google, people are not searching less on Google. That just hasn't happened. By the way, I own Google. So Justin saying I'm going to get sued by Google lawyers. I own some Google. That is my only big tech allocation. So I'm saying this as an investor that has allocation to Google. I've obviously made a decision that Google is my big tech allocation. And I've made a decision a little bit based on the risky nature of it because it's trading at the lowest PE. So I'm like, you know what? I want something cheap. Google seems cheaper than every other big tech company. If I had to pick an allocation, it would be Meta. But the problem is Meta is just getting way too much up there right now. I know a lot of people are going to hate me for saying Meta, but I love Meta. Meta's just getting way too up there. So the problem, is that if Meta is getting up there, then, it's going to be hard to buy it right now. But Amazon, Nvidia, all these guys, I like a lot of these companies. Amazon being the second one I would pick, but Google is the cheapest. Google right now, PE is at 23.47. It's probably going to be a little bit lower as the market opens. S&P 500, 461 in the pre-markets. And what else do we have right now? DoorDash at 101, Zoom at 72, Apple at 193. Rubicon Technologies actually up 5%. That company we're talking about with Palantir. Tesla is at 239 right now. Nvidia 466. Google seems the cheapest, but Google is going to take a while to be able to recover. Could be cheap for a reason. That's correct. And that's the risk, right? Could be cheap for a reason. And that ultimately is a risk. JS says, I see 25 for Google. For Google, no, I think it's 23. I'm looking at Webull. Yeah, forward PE. Oh, you're looking at trailing 12 months. I'm looking at the forward PE. So yeah, the 23, 25. Either way, it's still the cheapest big tech that we have out there. John says it's not just ChatGPT. People search in many more places than back in 2010. Amazon for shopping, X for news, etc. I agree. I mean, people are searching more on TikTok than they're searching on Google, right? And so we're getting a lot of different arguments for why Google search could be declining. At the end of the day, I just think a lot of their capabilities and their AI-enabled LLMs are going to enhance something like YouTube or something like Google search versus necessarily make it bad. For those that are just joining, I want to give you guys a quick update on CPI. We came in at 3.1% year over year. We were at 3.2% last month. So we did come down 0.1%. It was not enough to get people, to get the market super excited. The market did rally just a little bit. We were at 463 in the pre-markets on the S&P 500. I didn't even know we were at 462 yesterday, but we were at 463. And now we're declining a little bit right now. The S&P at 461.77 because it just wasn't enough to keep it going. The main headlines is index for shelter continue to rise, index for used cars continue to rise, index for medical care continue to rise. Gasoline came down 6%, 2.3% on the energy index. And that's why we saw a nice 3.1 versus 3.2 or even 3.3. So we got it to come down, but we didn't get it to come down aggressively enough because there were enough things that were going up, like shelter, like Medicare or medical index, and also like used car index. Apparel went down as well, and food rose just slightly less than what it rose 3.3% in October, 0.2% in November. So we got some things going down, but not down enough in order to get inflation to ultimately get to a reasonable rate for the market to be super excited. All right, folks, we got 10 minutes until the market open. We're going to watch another clip, but before I get into that clip, I have a confession to make. I'm in love with two women. Okay? I'm in love with two women. One of those women happens to be in Canada, unfortunately. I wish she was in New York, but she's in Canada. I can't do anything about it. She's in Canada, but I'm in love with her. I don't know, I don't know what to do. But in fact, she might be the background of my phone for some reason. That's just, somehow, and now I have to look at my lock screen every day, and I'm like, oh my God, I'm in love with this woman. But the other woman that I'm in love with, she just happens to be the chief economic strategist at JP Morgan. Folks, CNBC got her back. If you've been a fan of the market open, you know Gabriela Santis, my one true love. I know I said I'm in love with two women, but this one is actually the woman I am deeply in love with because she whispers sweet somethings into my ear when she talks about inflation. She is back and she is a little bullish on the stock market, even though CPI came in at 3.1%, not everything we expected. Let's hear what she has to say about the future of the stock market. Here we go.
Talk of the tape, whether the market and Fed are aligned or at odds, and how that could influence the rally in the weeks ahead. Let's ask Gabriela Santos, Chief Strategist for JP Morgan Asset Management, with me once again at Post 9. Welcome back. It's good to see you.
Good to see you.
How are you thinking about what might happen this week?
So it is the last big week of the year, and really investors are going to be looking for that confirmation of growth without inflation and peak rates, looking to the other side of rate cuts and exactly what precipitates them. We think it'll take, at this point, a big surprise on the downside or the upside to get much movement when it comes to the stock market. And that actually, if you look at bond yields, we're still a bit vulnerable because of a little bit of dichotomy between what investors are expecting for the first rate cut and what the Fed is likely to do.
Okay, let's go there then, because that's sort of how we set up this conversation, whether the market and the Fed are aligned, or whether they're at odds or offsides with one another. You think they're a little offsides?
A little bit. I think in general, the direction is clear. We've seen the last rate hike. The next move is going to be a rate cut. But I think that if you look at probabilities, there's still a actual economic slowdown likely to see that, even though we actually think inflation will come down faster than the Fed is expecting. So it's really just talking about pushing it back a few months, expecting the first rate cut to happen in June or July.
And this, I agree with Gabriela as well, right? I think Gabriela is very on point with this. A lot of people are expecting a rate cut sooner than later. She thinks it's coming. She just doesn't think it's coming in March, which makes sense.
Dramatic.
You're expecting cuts, though, in 24.
We do expect cuts. So it's nothing dramatically offsides. It's just in the very short term, you could see a pop in yields as those rate cut expectations are adjusted a little bit more in line with the Fed.
Are they cuts because they can or cuts because they have to?
So in our base case, we continue seeing growth without inflation, which is what the jobs data confirmed last week. And we hope to see also in the CPI and retail sales this week. So in that environment, rate cuts by mid-year really are because they can, because inflation is coming down faster than they expect. And that opens the door to start actually lowering nominal rates so that real rates don't increase much more from here.
Do I make the leap and then say then you must be bullish stocks for 2024?
I think the number one conclusion for us is a lot of investors are frustrated with the markets this year because they sat on too much cash.
And she is right about that. She is absolutely, probably everyone in the chat can relate to that to an extent. If all of us had just stuffed our money into FANG, and not, thought about it too much, we would be up almost 80% for the year, right? A lot of investors are upset. They did not put their money into the markets. They got that 5%. Markets up 20%. Individual equities are up 300-400%. If you look at certain names, obviously, big tech up 70-80%. So a lot of investors are upset. And her argument is that money is going to trickle into the economy, even if we don't get a rate cut by March.
And despite all the ups and downs, the 60-40 still gave you 3x cash this year. It'll get even worse next year, given that we think the peak benefit of cash is behind us. So that's the number one thing to do. Use the pop in yields when they happen to extend duration a little bit. Use pullbacks in the market to actually lean in to some of the laggards where it makes sense. You don't want to go too on the other extreme of risk either.
Okay, so you're talking about a rotation from cash into the lagging sectors of the market, the ones that really didn't wake up until the beginning of November.
Yes, and I think it's a very fast changing market. We went very quickly late October to how high can rates go when it's a very concentrated, narrow leadership, all of a sudden to how low can rates go and an everything rally. So you don't want to be participating on either of those extremes. You do want to diversify exposure, but you don't want to lean into, for example, for us, not quite the time yet for small caps or financials or retail.
Why not small caps? Because the Russell's Russell's up almost 11% in a month. So if you think there's going to be a broadening out and the economy is going to hang in there, the Fed cuts because they can, not because they have to. Why wouldn't I want small caps?
So I think we do still want some allocation to small caps, and you still have valuation discounts, historically large versus large caps. So building some exposure, but if it's about overweights, that marginal dollar, we would still prefer quality large caps. And that's because a soft landing still doesn't mean things are great. And I think the discussion for next year is going to be a lot more, where are we in the cycle? Where do you see pressures late cycle? And that tends to be small cap. Small caps also have a lot more floating rate debt, so they are already feeling the pinch of higher rates, and the Fed is unlikely to cut it fast enough to ease that pain in the immediate future.
But it's fair to say you're a believer.
So that is why I like listening to Gabriella. I mean, I think it was a pretty sober take on what's going on with the market. She also talks very slowly, enunciates every syllable. Some people think it's scary. I think it's very sexy, quite frankly, especially when she's bullish. And, you know, Gabriella has been bullish really since the summer. And the reason she's been bullish has been because of this broader argument that at the end of the day, money has to come into the stock market. Inflation is coming down. Equities are going to do better because earnings growth is going to be up there. So her argument is kind of the basic, simple argument for why markets should go up. But she does a really unique analysis around how the bond market interacts with the equity market. And she started talking about this back in July, how we were going to see the 10-year start to come down back when the 10-year was at almost 4.7. in order for equities to go higher. And so from that perspective, I think Gabriella is correct on this. The thing that I think messes up her thesis is if unemployment dramatically comes up and if the Fed has to cut rates because something's breaking in the economy, because then maybe the stock market doesn't do well if something's actually breaking in the economy. For example, if unemployment goes up, consumers don't have money, people don't have a job, people can't really buy things, right? So earnings are not necessarily going to go up. And that's not going to be the best thing in the world. Granted, if the economy doesn't break, if we're in this kind of Goldilocks zone, I think the market's actually going to be okay. And if the market's going to be okay, then, you know, we're going to see things like small caps, as she said, go up as well. But all of this depends on the next 3 to 4 months of data. And the data we got today, thank you 790 people for being here. 3.1% headline inflation. Gas is down. Shelter is up. Used cars are up. Medical index is up. Food is up slightly, or food is down slightly, but not as much as, you know, we wanted it to be down. All of that put together, put in headline CPI at 3.1%. Core CPI, which is what the Fed actually looks at, is at 4%. It's unchanged. And so the FOMC meeting is tomorrow, as we have about 2 minutes until we get into the market open. Robinhood up 0.68%, Palantir up 0.17%, and S&P is down slightly, 0.09%. Fed meeting is tomorrow. What is the Fed going to do? I think the Fed is going to be as hawkish as they can possibly be, because Jerome does not want this market rallying. And the reason he does not want this market rallying is because he doesn't want people to get euphoric about the stock market, or just euphoric in general about the economy. Now, granted, his agenda is being accomplished. We got about a minute until the market opens. Inflation's coming down while growth is not necessarily falling off a cliff. I don't know if Jerome wants growth to fall off a cliff and he wants unemployment to go insane, because that's not happening yet. But he's managing keeping the economy alive without destroying the United States economy while inflation's coming down, which is what you need to be able to do. He has that dual mandate, obviously. If inflation can keep coming down towards March as the economy doesn't break, I think we're going to have a good 2024. The question I think that's on everyone's mind is something going to break? And if something breaks, then we're in for a hard landing. If something doesn't break, we might have a little bit of a soft landing as well. SJ says Amit has crazy eyes too. Yeah, Gabby has some of those crazy eyes, but that's why I like her. She's, she attracts me with those eyes. We're going to listen to Gunjan speak after the market open. She was talking about options volumes being the highest they've ever been for retail. So that's something that is another data point to look at it as well. But in general, retail is very excited. I mean, retail option volumes are just absolutely insane. Did you guys know what 0-day expiration options were? Apparently this came out a couple years ago. I didn't even know this was a thing, but like there's these like new products that retail is just eating up when it comes to options. So there is a lot of euphoria going into the markets. The question is simply, is it sustainable, and is the macro going to let it persist? 9:30 a.m. December 12th, 2023. Thank you everybody for being here. The stock market is once again open. Wake your ass up. Here we go. All right, let's get into it. CPI came in. S&P is basically flat, down 0.10%. So S&P down just a little bit, not too bad. S&P right now 461.68. Robinhood 1182, up 0.77% right now. And Robinhood was actually 1190 last night. Right now at 1180. So it's down a little bit from the pre-markets where it was at 1184, up 1.07%. We'll see where it continues to go. Palantir up 1784 as well. Palantir did hit 1814 last night, something around that range. Right now, 1785, so not too bad, 0.45%. Bitcoin, 41,753. Bitcoin is down from 41,900 just a couple of minutes ago. So we're seeing Bitcoin come down a little bit on the CPI report. Tesla is red. Russell 2000 ETF is red. Nvidia is red. Meta is green. As soon as I was about to say it's red, up 0.04%. Microsoft is red, basically flat now. Now it's green, 371.54. SoFi down 807. SoFi was at 825 yesterday. Now SoFi at 807. By the way, while we're talking about SoFi and Palantir, let me just bring up this one thing. For those that are just joining, Palantir did unveil a new partnership today with a waste management company. That is on my Twitter for those that want to check it out. It's the third tweet, so you can check it out. Twitter is in the description. Short interest on Palantir and SoFi. Real quick, let me do this. Palantir shares sold short are now 121 million. That is down 17.4% from last week or 2 weeks ago. The percent of the float of Palantir shares sold short are now 6.64%, down from about 8.5%. So we got a nasty decline. People are covering their shorts for Palantir. The reason I think we're seeing the decline is because institutions are selling, but that doesn't mean that institutions are shorting. SoFi has increased their short float by 8.9%. 142 million shares are shorted. 16% of the float is short SoFi. So that is why it's SoFi is having such a hard time to run up. I think the shorts are either thinking delinquencies are going to run up dramatically in 2024 or something's going to break. But they're being pretty cocky right now, doubling down. I mean, that's up almost 4 or 5% from 2 weeks ago on the short report. So SoFi short report definitely coming in hotter than expected. CleanSpark is up 0.8%. MicroStrategy up 0.77%. Google down 0.62% on the Epic Games lawsuit antitrust case that Google lost, that Apple somehow magically won, but Google lost. Google 133.89 on the day. AMD is up. AMD, I mean, whoever got in at 118, congratulations to you. I mean, this thing has just absolutely skyrocketed. It was at $100 on October 31st. They had a new presentation of last week on like Wednesday. And that new presentation just blew investors out of the water. They're saying they're going hard for NVIDIA's H100 chips. And so it's doing well right now. AMD up almost 10% in the last, more than 10%, about 15% in the last couple of days. Bitfarms up 5%. Hut 8 Morning up 1.1%. Marathon is up 0.6%. Coinbase up 1.83%. Riot down 0.32%. Robinhood up 1.06% at $11.84. HIMS is down a little bit. Ginkgo Bioworks down 3.6% on the day. What else do we have here? What else do we have? We have Lilium is up just a little bit. TFC 34.08. TFC is down about 1%, 34.12. It was touching close to 35 in the pre-markets. Right now it's down. C3 AI is at 27.91. Lucid, the CFO, left yesterday. So Lucid is down about 5% on that news as well. Unity is at 32. I haven't looked at Unity in a while. Unity was at 25 last time I checked. So Unity doing well at 32. Tesla 235. Robin at 11.83. Palantir 17.83 on the day. CPI came in hotter than expected, and that CPI, well, not hotter than expected. It was basically consensus at 3.1, but core was unchanged, which is why the markets weren't necessarily the happiest about what we got with CPI. Oil below 70. Oh, wow. Oil is below 70. Let me check. 10 years at 4.245. 10-year picked up from 4.1. Oil prices, let me look at this. Where we have WTI. Wow, look at that. WTI crude down at 69.41. 69.41 on oil. We got it going down. I mean, look, it's a good thing for inflation. Long term, not necessarily the best to have oil getting to these prices, but for at least for inflation, for that energy index. If we didn't have energy index go down to 0.4, or to go down 5% on gas, 2.3% for the month, we would not see the decline that we saw right now. Let's get an update from some heads and what they thought about CPI and see if they had anything unique to say around CPI rising. And then we'll get into Gunjan and what she has to say about retail option volumes.
In this data, we want to bring in our senior economics reporter.
Well, first of all, some things I think that might concern the Fed is that we're still not getting the sheltered disinflation we thought we might get. I think that's going to be a bit of talk about that today.
That is not because of disinflation not happening. I think that's because of lagging data. I honestly think and that'll show up in January, February, but that's just the Fed being behind 6 months. I don't think that's because it's not actually happening.
0.4 on the shelter after 0.3. I don't have the owner's equivalent rent right in front of me. That's another table I can call up in a little bit. But food at home is down. Talk about people are concerned. There's been some, I've noticed this, that in the circulars you get, there's a little more price competition, perhaps at the grocery store. That's up. Food at home, just 0.1% overall. Food 0.2. And as Rick pointed out, gasoline flattering this index down 6% on the month, down 8.9% year over year. And then a big surprise here is an increase in used car prices, up 1.6. There was general belief this was going to fall. It did not fall. It was down 0.8 in the prior month. The reporting by Phil LeBeau had suggested it might fall because of his reporting from the auctions. Another interesting thing is we talked about all this holiday spending that's been out there. 2 points. One is that apparel is down 1.3%, but also real earnings, inflation-adjusted earnings up 0.5% after being negative. So as you'll note, the CNBC NRF.
So, I mean, that's not bad as well. It's going to be really interesting to see what happens for the holiday season, not only just on earnings for Q4, but what's also going to be really interesting is essentially how much sales volume there is. Black Friday, Cyber Monday, if we remember those Shopify stats, 22% year over year. They did like 4.5 billion in gross volume that they handled through the website. It's just absolutely insane. So people bought, consumers bought. They have enough of the job to pay for the stuff they buy from China, from Shopify stores. So there was enough momentum there. It's going to be interesting to see how that impacts Q4. Obviously, if it impacts Q4, that means more money is going to be spent on advertising. Big tech makes a lot of their money off ads, right? So all of this coincides with a good holiday season. But the question is, how big is it going to be? Or if inflation's still sticky enough to where people don't want to spend as much as they wanted to spend before. Richard says, good morning. Richard, good morning to you. For those that are just joining, headline CPI came in at 3.1%, below 3.2% last month. Market liked it. Market did not love it, which is why the S&P is down 0.25%, but nothing too dramatic. Stocks are red in as the market opens, but nothing insane. If we had 3.3 or if we had 3.2, this would be not necessarily the best. Enphase down about 4% on the day. Palantir at 17.75 on the day. Let's get into some retail momentum. So let's pull up this video that got 20,000 views when CNBC barely gets like 2,000 views of video. And it's because our good friend Gunjan was in the thumbnail. Here's her analysis on why retail investors uniquely are excited for where the market is going and where she actually thinks there might be some issues with the market if things are going to get a little bit too intense with where the market's going. Let me actually get the right clip because that was the wrong clip. She was on 5 days ago. So here's the right clip. Oh, this one got 14,000. Okay, so still 7x more than what CNBC usually gets. This is actually really an interesting data point because if retail investors are betting heavy on the market going up, they could either be in for a rude awakening or they could be right against, where the market's heading.
Options market is booming with the most action it has seen in at least 50 years. That is according to an analysis done by the Wall Street Journal. Gunjan Banerjee, the author of that report, joins us here on set. She's also a CNBC contributor. Gunjan, great to have you with us. And it's amazing how much it's risen, but also what it's been driven by, and that is short-dated options.
That's right. There's been a mania in these shorter dated options known as zero DTE, and that's really helped turbocharge this mania that really began in 2020 during the pandemic when people were stuck at home. They were opening their Robinhood apps and playing the options market. And since then, the activity has just soared and soared and soared. Shorter dated options recently made up around half of all activity. And, this is a new product. This is something that wasn't even on the scenes, last year, 2 years ago. So it's pretty remarkable when you look under the hood.
Is there a sense of what percentage of those zero dated options are retail driven or institutional?
Many of those zero-dated options are retail-driven. They are part of the mix, especially in the market for S&P 500 index options. I've seen mixed estimates of that, but rookie investors, they loom large in this market. They actually make up a greater share of the options market than they do the stock market. Of course, that raises concerns of, are these individual investors taking too much risk out there in markets?
Some of the most popular trades that you highlight in your report are sort of the usual suspects, AI. Tesla is always the most popular individual option. What other things have risen to the top?
It's really been a way for people to magnify their bets on AI. I was surprised to see Tesla, make the top of the list once again, especially because of how popular NVIDIA has been as a trade. It also seems like these one-day options, they become a way for people to play the economic uncertainty that we've seen this year. 4 out of the top 5 trading days for one-day S&P 500 options were around days like CPI, the labor market data, GDP data. So watch out for that in trading tomorrow and Wednesday when we see CPI, PPI, because that's been a way for people to play these huge moves in stocks and bonds through things like TLT.
You mentioned that these options didn't exist a year ago. What is on the horizon? Is there a slice in the options world that is even shorter dated than what we have now?
If there is, I think exchanges and brokerages are going to try to, create it out of thin air, because this is a cash cow for ETF providers, for retail brokerages. Let's not forget, options make up, they're much more lucrative for these retail brokerages than.
That's a big deal for Robinhood as well. They make money off the volatility, and Robinhood now makes, I think, 3 cents a contract. So there's a little bit of profiting they can do here, or at least they don't have to pay for the cost anymore since the consumer pays for the cost now.
And stocks are, because of payment for order flow. That's one of the biggest sources of revenue. And I think people are going to try to, capture this golden goose while it's still around.
So, I mean, retail's excited. Retail's very, very excited about what's going on. And we're seeing it through the options interest. If retail's buying options more than institutional investors, then retail is betting on the market going up. That might not be the best thing because options are a bit more risky, especially. I don't get how some of retail does weekly or monthly options. I don't get it, bro. I literally do not get it. If I do an option, it is always a leap. It is always 2 years out. In fact, I got rid of all my 2025 options and I put those suckers into 2026 because I didn't want to wake up with the anxiety of 2024 wondering if I was going to hit my strike, because those strikes are a little bit more out of the money and I wanted some more time. So I was like, let me give myself 2 years, even if I'm going to miss out on some of the premium or I have to pay a higher premium for that extra year. I don't get how people pick 1 week or 2 months. Someone YOLO'd like $1 million into Robinhood options on Wall Street Bets yesterday for a $12 strike expiring this Friday. $1 million. Like, I mean, I guess people have money to play around with and lose, but even if I had $1 million, I couldn't do that, dude. Like, I couldn't. Robinhood right now, 1161, down 0.84%. So his options are probably down right now. It's just, it's too scary to do weeklies or monthlies. It's too scary. I need a year. I need 2 years. So I don't know. The retail interest that thinks that they can time the market for the weekly, I mean, go ahead, be my guest. And some of them are successful at doing it, but those are like the 0.001% that have been doing it for at least 10 years now. The ones that are just getting into it, who the hell knows where Meta is going to be on Friday? Like, who knows? Now, give me a Friday 2 years from now, I have a decent understanding of what Meta could be at. And even that could be totally fucked if we have some type of event that ruins everything, like a Black Swan event. But I don't understand, all the momentum around retail options that are ending, weekly or monthly. SoFi at 789 right now, down 2% on the day. GameStop down 0.73%. S&P 460. Robinhood at 1157, down 1.24%. Bitcoin 41,621. Palantir down 1.3% of the day. 1750. Look, I've said it live on the stream many times. I have money ready to go to load up on Palantir. Give me 15, and I will give Palantir my money. But you got to get me to 15. Gotta get me to 15. I don't want to load up the amount I want to load up at 17. So, I mean, look, if it happens, I won't complain. But also getting to 15, I still think is going to be hard. You're going to have to see a lot of sell side pressure. Remember, the short interest has gone down from 8.6% to 6.4%. So shorts are covering. Shorts are scared. The rally, they put on their pants. But institutions are not buying. December, they are taking some of their profits. We saw the Canada Pension Fund yesterday sell 111,000 shares. And some of that selling ended up leading to Palantir just starting to go down a little bit more. I wonder why Robinhood is called Robinhood. I think Vlad wanted to take money from the rich and give to the poor people who are investing. Yeah, I mean, the whole concept of Robinhood. There's a foundation called Robinhood in New York City, by the way, that deals with economic injustice. My friend, I saw on his LinkedIn, he was working there. I was like, oh, you work at Robinhood? And no, he's working at some fucking nonprofit. I was like, all right, I don't give a fuck about this nonprofit, to be honest. I'm sorry. I'm just being honest. I don't care if you're working at a nonprofit. I care about that tech company. Like, that's what I care about more. But Robinhood, the whole concept is around stealing from the rich and giving to the poor. And honestly, I believe in Robinhood's mission. I mean, I am someone who did not have access to financial literacy in the financial markets, and Robinhood is what has given me a lot of the ability to learn more about the markets. By the way, they're giving out a free $1 of Bitcoin. So if you're on Robinhood right now, you can take a test. And if you get at least an 80%, you'll get a $1 of Bitcoin. So I got a $1 of Bitcoin. You know, the question I got wrong? The question I got wrong was how many Satoshis are in a Bitcoin? I said, oh, it's 100,000. No. It's 100 million. I was like, oh, okay. That's a lot of Satoshis in a Bitcoin. So I got that question wrong, but I got a 4 out of 5 and they gave me a $1 in Bitcoin. Robinhood also extended their 1% match uncapped to January 31st. Meaning it's working. They were giving 1% unmatched, which means you could bring in millions and millions of dollars and get 1% on top of it if you have a big brokerage account from like Schwab, Fidelity, etc. A lot of people took advantage of that, which is why they're extending it to January 31st. They said December 8th was the last day. They would not be extending it unless they saw it was working, and it is working pretty well, which is why we're seeing it as well. Chris says, Amit, how much would you pay for Gunjan Banerjee's used bathwater? You guys are ridiculous, bro. First of all, I don't have to pay for her bathwater, okay? Because Gunjan and me DM, all right? For those that don't remember, type in Amit Wall Street Journal reporter on YouTube, and she actually joined the channel for 20 minutes, and it wasn't 20 minutes, it was like 7 minutes, but you get my point, right? I wasn't able to last that long. We were talking about the stock market. And so it was, dude, I was nervous in that interview, bro. I was like, I better not fuck this up. But it was a good interview, and we got to get her back on the stream. We got to get her back. I'm going to DM her. I'm going to ask, yeah, hey, you want to come back? And let's see if we can get her back on before the end of the year and have her here. Spotify 196, PayPal 58.56, Enphase 99, Enphase falling below 100, Amazon 145. Amazon actually holding up really well with the FTC lawsuit. Verizon falling down 37.37. Truist 34.34. Robinhood again 11.61. One thing I like about Robinhood yesterday, crypto was down. All the crypto stocks were down pretty badly. Let me actually show you a chart of how bad they were. Robinhood was flat and it ended up higher yesterday. And this is why I like Robinhood. Crypto is a catalyst for Robinhood, but it's not necessarily directionally proportional just to crypto, because they're more than a crypto company. They're much more than a crypto company. And as a result of that, Robinhood is able to perform in a way that's not necessarily just tied to the Bitcoin company. So Robinhood was flat and ended up green for the day, even though Bitcoin companies were down. As you can see yesterday, Marathon down 12%, Hut 8 Mining down 13%, CleanSpark down 15%, Bitfarms down 11%, Riot down 11%, Coinbase down 6%. Bitcoin was down 5% in the last 24 hours, and that's why it hurt them. A lot of these companies are still up triple digits year to date. And so that's why we saw some of those stocks come down. Also, one thing I wanted to show you guys, and let me get your thoughts on this. I shared this on Twitter. I didn't know people were that interested in it, but apparently people are very interested in it. This is Nancy Pelosi's holdings. Okay. Nancy Pelosi holdings. We're going to make this a chapter in the pod. Nancy Pelosi holdings. What do you guys think of Nancy Pelosi's actual stock portfolio right now? By the way, there's a senator who bought a crap ton of Microsoft the other day. I forgot the name of the senator, but I saw the news yesterday. He's betting that Microsoft's going to do really well. He traded like millions of dollars in Microsoft yesterday. But this is Nancy Pelosi's holdings. Did Amit just say Shatosi? yeah, basically. Shatosi. Sorry, it's Shatosi. Apple, Microsoft, Google, CrowdStrike, Tesla, Amazon. I don't know what AB is, and then Disney. It's not that crazy of a portfolio. It's actually very similar to the big seven. She's got CrowdStrike in there, which I think it's a nice replacement for like an NVIDIA. CrowdStrike is a smaller company, still growing really well. Disney, that's, I guess Disney's went up a lot over the past couple weeks, so Disney's in there. Amazon is in there, even though Amazon's being investigated by the FTC, so maybe she knows something about the FTC. It's not a horrible portfolio. Dexter says she's a tech bro like us. That's true. She's also a tech bro like us. If I wish there was a Pelosi ETF, I would buy it hardcore. This is interesting because the problem with the Pelosi ETF is that they report trades 45 days after. That's the biggest problem with the politicians. So you don't really know what they're buying and trading. Like, we know she owns Disney, but right now she could have sold Disney and none of us know for the next 45 days. And by then, if the stock price goes up or down and you thought it was going to go up because she owned it 45 days ago, then, you're kind of screwed if you bought it based on that logic. So that is the only problem with the politician reporting. I think it is absolutely insane that United States politicians can govern our society, make the laws that dictate the very nature of how these companies operate, and get to trade their stocks. That is just insane to me. Apparently, Elizabeth Warren has a $67 million net worth. I saw this was out there yesterday. Correct me if I'm wrong. She gets a $285,000 salary. She has a $67 million net worth. And she's talking about, taxing the rich and taxing unrealized gains. Dude, I don't know. I mean, this is just insane. Some of these politicians are just absolutely insane. Dude, like taxing unrealized gains, I think is like, I just think you got to be dumb to do this. Like, I think you got to be like kind of dumb for this to happen. Like this is just a lot. Some people saying it's not 67, it's 12 million, regardless of what it is. She's a multimillionaire and she's talking about we got to tax the rich. And it's just like, come on now. This is just stupid. This is just stupid. It's because she had a part ownership in a bunch of casinos. What? Warren owns casinos? Oh, I think I get the joke. Chris, I think if you're making a joke, I get the joke. I think if you're making the joke that I think you're making, then I get the joke. Oh my gosh. That's hilarious. Everyone makes low salary, but it's somehow multimillionaire. Even Bernie. This dude Bernie at like $2.7 million. Look, that fucking went viral. It's just absolutely insane. Sorry guys that the thing is frozen real quick. It's freezing back and forth. I did get new internet over the weekend, but it's not going as well as it needs to go. Chris, that casino joke was goated. That was a good joke. That was a great joke. So yeah, I mean, a lot of these politicians having this leverage, it's just a little bit hard to believe seeing them get this leverage. Okay, let's end it off with one piece of news, and then I think we'll go from there. What did I want to show? Let me just pull this up real quick. In the meantime, let's take one last look at the equity markets, and then we'll get to one last clip, and then we'll be done for the day. Okay, so let's take a look at where equity's going, and then we'll finish up here. So 22 minutes after CPI comes out, or an hour after CPI comes out, Robinhood 1167 up 0.2 or down 0.26% of the day. Palantir 1770. Bitcoin's actually down 41,400. Bitcoin's at 41,900. So Bitcoin's seeing a little bit more of a decline. Tesla 235, Nvidia 471, Meta 327, SoFi 790, Microsoft 371, CleanSpark 881, MicroStrategy 557. Microsoft is down from MicroStrategy is down from 590 early in the week. S&P 500 recovering a little bit right now at 461 as well. Bitfarms is up 6%. Marathon is up a little bit. Snowflake at 192. Snowflake, $63 billion market cap. Snowflake doing absolutely phenomenal right now. For those that are just joining, Palantir introduced a new partnership as well. That's on my Twitter. I'll talk about it on Daily Palantir episode today and on the newsletter, dailypalantir.com/subscribe. If you're not subscribed, free newsletter, I'll be discussing their new Palantir partnership with a waste management company. But those are some of the main headlines. Let's check on Google as well. Google, I still think, is a little down today. Google lost their lawsuit that they got sued 3 years ago from Epic Games. Apple was able to win their lawsuit. Google was not able to win their lawsuit. So Google is down. This follows a day after they faked their Gemini video. So the market really not showing too much love to Google. Robinhood 1169 and Palantir 1778, 1777, just slightly red on the day. All right. I think that's pretty much it for me today. That's another thing. Blake says she'll go after Musk even after he paid the most in taxes. Musk paid like 50-something billion in taxes or some ridiculous number back in 2021. It was the most taxed a person's ever been taxed ever, even though a lot of his money's in stock. But she went after him as well, And so it's really crazy just to see how much she goes after some of these people, even though, they do contribute a lot at the end of the day to the economy. James, I see your comment there. Okay, word of the day. We ended off with word of the day. If you are new to the Market Open live stream, which some of you might be, thank you 770 people for being here. We end the day with the word of the day. And that's how we make sure to all use the word of the day in our daily lives. Everyone, I get a bunch of texts throughout the day of people or DMs, people saying how they use the word of the day. Today's word of the day is hallucinate. Now, this is a boring word of the day. So we're going to need a better word of the day because hallucinate is, we already know that word. So let's do Merriam-Webster. Let's get a better word of the day. We need words of the days that are challenging. Look, Merriam-Webster is mentor. Are you kidding me? Like, can we get a real? Okay, here we go. Vocabulary.com. Supererogatory.
Supererogatory.
Why did she say it like that?
Supererogatory.
Is it just me or the way she's saying it? It's not just me, right? Please tell me it's not just me. Something that is supererogatory goes way beyond what is required. Washing all the dishes, sweeping the floor, and taking out the trash would be supererogatory if your dad only asked you to put your plate in the dishwasher. Okay, so one day when I'm married and I want to spice up the eroticism in our marriage, but it's been 10 years that we've been married, and my normal riz and charm doesn't create the eroticism that is necessary to get my wife turned on, I will be super erogatory with the dishes and sweeping the floor and taking out the trash, because I'm assuming those are the things in a 10-year relationship. That is what creates the eroticism through being super erogatoric in order to have a healthy marriage. Okay, that's it. Your boy keeps figuring out how to use these words, ladies and gentlemen. Your boy finds a way to figure it out. Cash King says, Amit, what do you think of Uber being added to the S&P 500? It's good. Uber deserves to be there. They're profitable. They're growing. I've never been the most bullish on Uber in general, but I mean, they deserve to be in the S&P 500. So congrats to Uber shareholders. I think it's up like 10% since it got into the S&P 500. So not bad at all. All right. That's it for me. Thank you everybody for joining. Daily Palantir episode will be out in a few hours. Chris says, don't be a simp. Stop the derogatory movement. Oh my gosh. Finance junkies, we got a lot to talk about with CPI. Chris is obviously seeing some cracks in the economy right now and maybe some fear for December, January. So we'll talk about CPI today, 9 p.m. on Finance Junkies. Please like the stream. We have 143 likes. We got 680 people here. If you could all just gently press that like button very quickly before you leave, that would mean the world to me. And then newsletter, dailypalantir.com/subscribe, free newsletter every single day. Email. If you're a Palantir investor, you should be subscribed to it. And you guys will get that email later today. That is it from me. Thank you, everybody, for joining. We'll be back tomorrow, 8:45 a.m. CPI came in at 3.1%. We'll see what happens throughout the day to the economy, and I'll see you guys then. Thank you, everybody, for joining. I appreciate it so much. See you guys tomorrow. Bye-bye.